Hello and welcome everybody to the channel. Today we're talking about Lowe's to see if they're a buy at current market price of $220.02 a share. Lowe's, as everybody knows, is a home improvement retailer, and essentially they're a duopoly with Home Depot. Now, I'm not a huge fan of retail, and one of the main reasons why, and I'll get into some of the details later in the video, is because of theft. And also because they typically have lower margins than what I like to see. However, one of the reasons I do like Lowe's is because A, they have a very good dividend, and B, they do have some reasonably good growth prospects going into the future here. So we're going to take a look at some of the metrics here, as well as Lowe's growth prospects according to the company itself, and we're going to see how they're going to create some of that shareholder value going forward. All right, well, let's get into it. All right, we're going to start out here looking at their My Investment Summary tab, and let's see what we got. So right now, they're trailing 12 earnings per share is at $10.16 a share, and they're trading, like I said, at $220.02. They currently have a market cap of $128 billion. For our valuation, I am going to use an 8% discount rate with a 3% perpetual growth rate. All right, let's see. We have a 21.7 PE ratio right now. And right now their gross margin, trailing 12 wise, is at 3.25%. Basically right around their 5 and 10 year average. And I'm going to get into a little bit more detail on that later. They have been increasing their operating margins quite a bit, which I like to see. And they also have a pretty nice free cash flow yield of 5.09%. I like to see a free cash flow yield above 5% because generally that's when you're going to see a free cash flow yield above that means you're getting better than what you can get out in like the treasury bond markets, for example. And also, too, we have a return on invested capital of 23.25%. And another thing on ROIC, I really like to see consistent ROIC above 15%, and Lowe's does that very well. All right, coming over and looking at a few of their dividend metrics, they have a 38.78% free cash flow payout, which is very nice and low. I like to see that. And we come up here, we see some compound annual growth rates. They're growing their revenue per share pretty nicely, over 13% over the last 10 years. They've gotten their operating expense margins down, and they're growing their earnings per share very nicely, almost 20% per annum over the last 10 years. And you can see they have a very healthy, robust share buyback program. And I'll talk about that a little bit more later as well. They also have an excellent dividend, $4.40 this year, and they've grown that dividend 20% a year for the last 10 years. Amazing growth there. And their free cash flow per share has also grown at over 17% over the last 10 years. And I'll get into why their retained earnings looks pretty awful here in a second. If you look at their scorecard here, these are a few metrics I like to grade companies on to kind of give me an idea of how they compare to one another. And one of the things I really like to look at is what I call my metrics here for the economic moat. And really it's looking at their gross margin percent, their 5-year average. I look at the CapEx as a percent of net income for a 5-year average, the ability for them to convert free cash flow from net income into free cash flow, and their SG&A margin as a percent of gross profit over the last 5 years as a 5-year average, the interest expense as a percent of operating income, 5-year average there, and of course their ROIC 5-year average and their return on capital employed 5-year average. That gives us a 3.143 score for their economic moat. And I like to see an economic moat at least of a 3. So I think that's pretty good here for Lowe's. Coming over to their share price returns chart here, we see that they've had very nice, great returns actually over the 3, 5, and 10 year. And even this year, they've returned 10.43%, and they're up 14% in the last 1 year. So excellent growth here. They have had a bit of a rough patch in the last few months here. I do think that's a couple of reasons, mostly the general malaise of the market right now, but also there are some general fears out there about retail, which I'll address here in a second. But all in all, I think they've had excellent share return here, and capital appreciation for the last 10 years. And I expected that to continue going forward. Taking a look at some of the charts here, what do we see? All right, so we can see they've had excellent revenue growth, and they've lowered their SG&A margin over the last 10 years, as well as increasing their operating income margin over the last 10 years. Excellent things that I like to see. They have excellent earnings per share growth. Now they're down a little bit in 2023, and I expect them to be down a little bit in this fiscal year as well. And I've baked that into my growth projections. But you can also see their really excellent share buyback program. And this is one of my favorite things about companies is when they have a very robust share buyback program. Now, if we take a look at some of the margin, looking at their margins here, we can see that the gross margin has slightly dipped in the last few years, while the net income margin is up. And I do think one of the big drivers for that gross margin dip is theft. And that's actually one concern I do have with Lowe's and other retailers in general, is they've been experiencing a lot of theft in recent years. So Lowe's even addressed that in their 2022 annual report, pointing out that during 2022, the inventory shrink reserve increased approximately 14 million to 428 million by the end of the fiscal year. And that's a pretty big increase. And that's, I believe, one of the major drivers towards their decrease in gross margin. However, if we look at their gross margins for so far the 6 months ended in this current fiscal year, we can see that they've increased their margins a little bit. So they are getting their margins back up. So that is something I like to see. In the 6 months ended, it's at 7 basis points above where they were last year. And the 3 months ended are very much higher over where they were in the same quarter from last fiscal year. And also looking at their operating margin here, they've done a nice job increasing their operating margin as well, despite some of the issues they've been facing this year with just the economy and the general malaise in the retail market. They've done a good job of increasing their operating margins. And now you can see their net margin is down a little bit, 10.71 this quarter from the previous quarter of prior year quarter of 10.89. It's up 2 basis points the 6 months ended. However, the reason I think this net income margin is down is because of the interest rate. And they've rolled over a lot of their debt. And because of that debt rollover, they've had to, of course, get it at a higher interest rate since the Fed has raised rates. Now, I don't expect that high interest rate environment here that we have currently to continue, but it still will be an issue for the next maybe year or so. However, despite some legitimate issues within the economy right now, they've done an excellent job of growing their earnings per share. They are up 8.32 earnings per share through the 6 months ended over 8.16 over the prior year, and down a little bit in this year-over-year quarterly period. But again, it's trending in the right direction in my opinion. All right, coming over to some balance sheet and cash flow charts, we can see a few things that do concern me on surface level here. So number one is a big ramp up in debt. So why is their debt going up? And then the other is a big ramp down in their equity. Why has their equity gone negative pretty severely here in 2023? And then the other thing that is a little concerning is they've had a bit of a downward trend in their free cash flow. I do think this will turn around after we get through this higher interest rate environment. And remember, I buy and hold for the long term. So 10 years from now, 5 years from now, I am not concerned about where Lowe's is going to be. I think they're going to be out of these issues that we're seeing in the economy, and they'll have back on track for their free cash flow growth. First, though, let's address their equity. So if we look at their consolidated statements shareholders' equity from their 2022 annual report, we can see that, yes, it is indeed negative, $14.2 billion in the red there. But really, why does that do? What does that due to? That's due to share repurchases. They've been repurchasing shares at a very impressive clip. Like I said at the outset, it was about 5% per year for the last 10 years. And that's pretty much the reason they've been driven into the negative on their equity. So the fact that their equity has gone down that much, the retained earnings, of course, as well, doesn't really concern me because it's for a good reason. It's for a share buyback. But then we come over to the debt side of things and we can see, all right, so let's look at their debt schedule here, their debt retirement schedule. And looking at this, we can see that the most recent debt they've acquired in the market is at those higher interest rates, 5.63 and 5.63% and 5%, and for the debt that's due in the 2050s. And also, we can look and see what is their debt due. This debt ladder here is, to me, not concerning. Given the level of debt they have, close to $33 billion, it's not as concerning once you dig into it because it's laddered quite nicely. A lot of it, there's no one giant payoff due in any one year. All of this is going to be very easily covered by their free cash flow. And really, through 2032, a bulk of that, almost half of it, $16 billion, is coming due by 2032. So they're going to be paying down some debt the next 10 years, and I do expect them to easily cover their debt service without issue from the free cash flow they currently generate. And one more thing I'd like to point out on their debt here is about $900 million is due through fiscal 24, and that's good because typically companies roll over their debt, and right now we're in that high interest rate environment. So they're going to be rolling over a very small portion of their debt at a higher interest rate. While once they start to roll over the rest of their debt, I do think by fiscal year 2025 and thereafter, we will see lower interest rates. So once they roll over these higher amounts, it's not going to be at those high interest rates. All right, so that brings us to our growth rate projections. And we can see here, I'm definitely projecting quite a bit of losses or lower growth than what they've previously had throughout the rest of this fiscal year. In fiscal year 24, I expect about a 10% decrease from the prior year. For net margin, I'm projecting roughly a 9.14% net margin throughout the rest of the year. That is roughly in line with what you see on their current trends for net margin from their current reports. And with their earnings per share. Now, this quarter, I'm projecting a 1,100% increase in earnings per share. But if we see back in last year, they had 25 cents earnings per share in this same quarter, which was a very big decrease. But the reason for that was because they had a $2 billion asset impairment one-time charge that they wrote off in that quarter. So they're going to get back to probably their normal levels here. And then 17% earnings per share growth over the next quarter. Now, the reason that I'm projecting earnings per share growth is because of that share buyback program. Reducing the amount of shares outstanding, of course, increases the earnings per share. And that gives us a 31.5% earnings per share growth this fiscal year. Free cash flow conversion, I'm estimating about $1.07 free cash flow converted from net income for this fiscal year. And then going forward, in years 2 through 6, I have about a 1.7 bump up a little bit in year 3 and 4 and 5, and then back down to 3.5% thereafter in years 6 through 10. That gives us a revenue growth here of 2.11% compound annual growth. For our earnings per share growth estimates, 6% in year 2, 7 in year 3, 8, 7, and then 6 through 10 at 5%. That gives us 8% compound annual growth rate for the next 10 years. And if we look up here, that's well below their historical averages. So I feel like I'm being very conservative, taking into account some of the retail issues that are out there, as well as the fact that they are a very mature company. So it's not likely they'll see that same rate of growth that they had historically. So coming over to our net income multiplier, I'm using a 65% net income multiplier, which means I project their net income to grow at about 65% of the rate of earnings per share. And we can see that gives us roughly a net income margin here of 9.3%. And by year 10, very much in line with their historical averages are, especially the last 8 quarters, and a net income growth rate for the next 10 years of 5.6%. And finally, free cash flow, I estimate about $1.22 for their free cash flow conversion from net income into free cash flow, which gives us roughly a 7.24% compounding annual growth rate for the next 10 years, and free cash flow margins up to about 11.3%, which again is fairly in line with some of the historical averages here. So I feel like I'm being very conservative and not overestimating what Lowe's can do. All right, so coming over to the discounted cash flow tab, we take those rates, we plug them in here, and we see that our projected free cash flow will give a discounted cash flow here for free cash flow will give us an intrinsic value of $169.5 billion. And with 585 million shares outstanding, that is a discounted free cash flow price of $289.79. And at a 20% margin of safety, that's a buy price of $231.83. Now, looking at our dividend discount model, we can see, first off, we can see excellent dividend growth for the 1, 3, 5, and 10 years. In fact, from our 10-year to our 1 year, it's grown quite a bit. And I'm projecting about 12% in 2025, 15 in 2026, 12 in 27, and 2028, 10% dividend growth. And that takes into account for in their more robust years, they tend to have higher growth for their dividend. And finally, perpetual dividend growth rate of 6.5%, which I think is easily coverable for this company, which, given their free cash flow payout ratio of 38%, I don't think a 6.5% perpetual growth rate is out of the norm. So that gives us a price here of $334.60 and a buy price of $267.68 with a 20% margin of safety. Okay, and finally, our exit multiples model. For my comparison companies, I'm using Home Depot, of course, Floor & Decor Holdings, Tractor Supply, and TJX companies, or TJ Maxx. And of course, they look a little bit weird there, but Lowe's themselves mentions TJ Maxx as one of their competitors in their annual report, so I put them in there. That gives us an average PE of these companies at 25.89, which is a exit multiples price of $263.09 with a buy price of $210.47 at that 20% margin of safety. So wrapping that all together, what does that give us? Well, we have $289.79 for our discounted cash flow, $334.60 for our dividend, and our exit multiple is $263.09. Grams, I'm not including in this one because it is not applicable to a company like Lowe's. And that gives us our final valuation here of $286.26, averaging them all together. With that is a potential upside of 30%. And like I said, I'm using that 20% margin of safety, which is higher than I normally use for S&P 500 company. And the reason I'm using 20% is because of the fact they are a retail business and they have that theft issue lingering over them. We'll see what they do about that there. But that gives us an acceptable buy price of $229.01, which is a buy right now, given our current share price at $220. And next week, when the market's open, I plan on adding Lowe's to my portfolio myself. Full disclosure, I do own Lowe's currently, and this is not financial advice. Well, that wraps up our discussion today of Lowe's. I hope you enjoyed the video. Let me know what you think by commenting below. And don't forget to hit that like button, subscribe to my channel, as well as hit that notification bell so you can get more content whenever I upload it. Thank you and happy investing, everybody.